Yeah.
Thank
So
you,
just
Sachin garu.
before,
Yeah,
Suresh
please,
Garu starts,
Rama
I
garu.
just wanted to introduce. I know Suresh Garu, Anil Garu doesn't need any introduction because they have conducted a lot of sessions on will and trust and financial aid related topics. So I think, yeah, all yours, Suresh Garu, Anil Garu, take take it from here.
Yeah,
Thanks.
thank you, Rama garu. Good morning, everyone. Um, my name is Suresh Kaku. Along with me, Anil Garu is also there. So today we're going to. Are you able to see my screen, Andy?
Yes, Suresh Garu.
Okay. So today's topic is basically how to build the wealth tax-free using the life insurance strategy. Um, so this would be the agenda, Andy, for today. So first and foremost, how we can protect our family. And then what are the types of insurances that are available? What is the difference between term and perm? Like somebody says term insurance, somebody says life insurance, somebody says whole insurance. So I'll explain you what are all the differences. And also we're going to discuss about, so what is the term insurance versus the employer group insurance? Like most of the employers offer the group insurance. So some of the companies offer for like 1 to 2 times the salary. And then also you have an option to buy supplemental insurance. So what are the advantages and disadvantages of taking a supplemental life insurance? We'll discuss that. Also, we'll discuss about mechanics of IUL. It's called Index Universal Life, and how you can save the taxes using that. And we'll also run through a use case. And there are like frequently asked questions. We will run through that, and then we'll open up for the Q&A. So if you have any questions during the presentation, I would appreciate if you can hold that till the end, or mention those in the chat, please. Thank you. Okay, so I mean, we all, most of us came here with 2 suitcases, right? With a family, the young family. So usually what happens is both the wife and husband, we hold all the responsibilities, financial responsibilities. So if something were to happen to one parent, then there is a huge financial imbalance, right? So that is where the life insurance comes into picture until the other spouse figures out. So this money will help to bring the financial stability in the family. So we have seen many people using the GoFundMe pages, right? Because a lot of people, they don't know that for like $10, $15, $20 a month, they can get reasonable coverage depending on the age and gender. So, and also many, so this one talks about like how what are the different stages of life, right? So many people think, oh, we'll get a $500,000 policy. Some people will say, oh, we'll get a 1 million policy. But there is a formula that we normally use to come up with that number. So in this example, it's a very young family. The kid is like 2-year-old and a 4-year-old. So we use the DIME method. You look at here, DIME method. So this guy has a debt of about 100K, student loans, credit card loans, or car loans together. And then he makes about 100K. So it's the rule of thumb is to have a 10 times the salary. So which is about $1 million. And then he has a remaining mortgage of about $300,000. And since he has 2 kids, so it would cost about $300,000 for education. So if you look at everything together, it's about $1.7 million. So he also has a current assets of about $500,000. So which means it's better to have a life insurance, either the term or perm, for 1.2 million. So in the event of something happens to the primary person, primary breadwinner, so they can pay off the debt using this 100,000, and also they can pay off a mortgage for 300,000. So they have a house to live, and also they have enough money saved for the education. and about $1 million left, so that until the other spouse figures out, um, this money would help to for the financial stability. Also, so we call this as X curve. The reason being X curve is, if you look at here, when we start our family, the responsibilities are very high, right? So, but as we progress in the life, the responsibilities will decrease, right? So let's say if you have 2 kids, the responsibilities will start decreasing once we pay off the mortgage, or once the kids are out of college, stuff like that. So in this quadrant, we don't need life insurance coverage. The reason being, even if something happens, there's no one that is depending on us. So at the same time, we all started with the ground zero, right? In this country, we need to start building the wealth with the various means, so that by the time we retire here, we have enough money to retire. So like back home, right? Back in India, once we have a paid out house and then some bank balance, so we can survive there long time, but not in US. So we have all these recurring expenses that won't go away even when we retire. So that's why it's very important. We for about a 45-year-old, so the retirement is about 20 years away from now. So it's suggested to have at least about $3 million, if not more, for retirement. And then, now we're going to talk about what are the types of life insurance, right? So this one about, second, let me take out this one. So in this term insurance, so many companies offer for up to 30 years, but very few companies, they can offer up to 35 years. Let's say, for example, if you're 40-year-old, you want to take a 35-year term, so that will cover up to 75 years. So, I mean, you can take as low as like a 10 years, 20 years, but maximum up to 35 years. And then other one is a permanent life insurance. This one is typically last for lifetime if we design properly. Okay. So then what are the differences between the term and perm insurance? So with the term insurance, it's provided in a specific years. Like if you take a 10-year term, it's only for 10 years. After that, you have to start a new policy. Often it's very expensive when you start the policy in the late age. So it's better to take whatever the number of years that you need, depending on your responsibility, upfront while you are healthy and young. So I've seen many of my clients took policies when 30 years, 35 years, they were paying much less. But some people are like 45, 50-year-old that has a diabetes, stuff like that. They're paying almost 3 to 4 times the premium if they were healthy. So that's why it's very important to take it when we're healthy and young. And like it says, right, once the premium is decided, it's fixed for the entire policy years. Let us say the premium is $1,000 for 35-year term. Then no matter what, even if the health goes bad, in the future years, you'll be paying only $1,000 premium annually. And but this one, in the term insurance, it does not have any cash value. So which means if you want to get any money out of the policy, you cannot get. But the entire death benefit is tax-free. Let's say if you do $1 million policy, so like in the above example, we said it's about 1.2 million, right? So that if something happens to that person, the entire 1.2 million is a tax-free. And also, this one has we call it as a living benefits. It's called chronic, critical, and terminal illness. So unfortunately, if something happens during the the policy period term, we can also use the money from this policy for any of these critical chronic. The critical meaning like any major heart attack, stroke, stuff like that. Chronic means if you're not able to perform 2 of the 6 activities of daily living, we can. And also terminal means if the doctor says the person is going to die in the next 2 years, so we can get 90% of the policy amount upfront. And then the next one is the index universal life. So here we can pay the premium in a flexible term. Like some people pay 7 years, some people pay 10 years, 15 years, or 20 years, even more if they want to. But beautiful thing in this one is whatever the premium is that you pay, that is going to have a cash value. And whenever the market is down, we don't lose money. But whenever the market is up, we're going to make money. So I'm going to show you in the next slide that will explain more. So also here we have the tax benefit is a death benefit is tax free. So similar to this, it also supports the long-term care, critical and chronic. Anil garu, did I miss anything, Andy?
No, Andy, I think you covered, Andy.
Okay, awesome. Thank you. So now we're going to talk about, this is very important slide at this time of the year. The reason being many employers are started their annual enrollment, right? So many people take supplemental insurance from their employer. Let us say our needed coverage is 1.2 million, just like in the previous slide. And let's say the employer is offering $500,000. And for the rest of the 700,000, some people take from the employer, and not knowing they may be paying a lot more. So like for example, I'm listing the differences between, this is the individual life insurance when you're taking it from outside the company. This is the employer provided. So let me, I'll show you both the benefits and disadvantages. So here it's a least underwriting and very convenient to take it with the employer. So the reason being the money is deducted bi-monthly or monthly whenever the pay cycle runs automatically without any issue. But if you are healthy, you will be often paying a lot more. So it is better to take it outside. And then if you're less healthy, it is better to take it with the employer because it's much cheaper. Let's say, for example, if you're like a diabetic, which has like a 7.2 or 7.8 A1C level, it is better to take it with the employer. And here, this is very important thing. Many people not aware of it. The premiums are annually renewable with the employer. So there are different slabs. So depending on the age group, you'll be paying a couple of cents for every $1,000 that the coverage. So the premium is not guaranteed, and it goes up drastically once we hit 45 years old. It almost doubles. But whereas here, once we define once we come up with the premium after the underwriting, the premium stays same for the rest of the period. So that's why I was talking about it's better to take the policy when very healthy and young outside. So the premium is constant and portable. So if you are with the employer, that for life insurance is there only with the employer. While you're with the employer, with the many employers, it's not easy to port. Even if you port, you will lose the critical, chronic, terminless illness benefits. But whereas here, it doesn't matter. Even if you switch company from employer A to B, this is still there because you're not confined to any employer. It's with outside. And no work-related restrictions with this one. And here outside, there are multiple options. You can customize basically. So I've seen many clients that are taking, so let's say they want to have $1 million policy, right? We can divide that into 25-year term for $500,000, 20-year term for another $500,000. That will reduce the premium, and also that will cover their need. So depending on it, we can customize it. But whereas here we cannot customize it. Whatever it is, you just need to pay that yearly, and then the premium could go up the following year. Okay. So in a nutshell, this is what the cash value policy. So thus far we discussed about the term insurance, right? So in a nutshell, term insurance, you take it for the specified number of years that you want for coverage. And then if something happens, we will get paid. So which is good. But whereas in the cash value policy, so this is we call it like an index universal life. So if you look at here, right, this is the stock market, the red one. So I came to this country in 1996. I saw all this drama. So it went up a lot during the dot-com boom, and it went down a lot. It crashed. And then it went up a lot, and then we hit the financial crisis, and then it went down a lot. And then after the financial crisis, then it started going up. It's been a bull market for many, many years, right? But now it started going down. So we don't know how long it's going to take, and we don't know how long it's going to take to recover, right? But this is, don't get me wrong, this is also a very good vehicle to grow the wealth. But the problem with this one is we don't know when we are going to retire, right? Like there was a joke that went around in the 2007 time. Hey, my 401k become 201k because they lost half of their wealth. So some people had to postpone their retirement. Some people had to work long years, right? So it was a big chaos. But whereas this green one, this is what the IUL policy about. So the cash value grows as the stock market grows. But if you notice here, it won't grow as much as the stock market grows. That is the disadvantage. But the beautiful thing is when the stock market goes down, we don't lose a dime. That is the key. And then when it goes up, then it goes up again. When it crashes, it doesn't lose value. When it goes up again, it goes up. So that is the beauty. So basically, we can be certain in uncertain times. So many wealthy clients use this method to be stable in uncertain times. So that's what it's in a nutshell. Basically, it goes up, the cash value goes up when the indexes goes up, and when the indexes crashes, it does not lose value. In other words, this is like a snake and ladder game that we play, right? So ladder, it goes up, it hits down. Ladder goes up, it hits down. So depending on wherever you are in the retirement stage, it's very important to have the stability, right? So I felt this is more stable. But for sure, you can get much better returns in the stock market at a given time. But in the long run, I mean, we have seen what's happening right now. Okay. So what are the mechanics of IUL, right? Sorry, Anil, do you have anything to add?
No, Andy. So here, so not to compare to the stocks, and just to summarize, this is only the comparison of the product, how that is going to work. Yeah, there is a pros and cons there, but this the product is definitely for the protection purpose. So do not compare to the stocks. Yeah, please, Andy.
Oh, thank you. Okay, so the mechanics of IUL is the pros: market downside protection. Like I said, right, when the market goes down, we don't lose a cash value. And death benefit is tax-free, and there are living benefits. Those are also tax-free. When you start taking out the money for retirement, that money is also tax-free. So it's not only tax-free during retirement. You can take the money anytime. Whenever there's a cash value, So for example, last week, one of my client, he's building another karate dojo. So he took out some money to pay for it. So you can take it anytime. It's not like you have to take it at the retirement. So, and then the growth and distributions all are tax free. So whereas in 401k, right, only whenever we deposit the money, that's you get the tax deduction. But when the entire cash, both the principal and growth is taxable whenever you retire and take the money out. Many people also use this as a legacy benefit, which means to pass on the legacy to the next generation. And so in 401k, there are contribution limits, right? Here, there's no contribution limits. So some of my clients are paying about 45,000 per year also. And there's no penalties for early withdrawal. Like if you want to take the money out for 401k, from 401k, above 50,000, you have to pay 10% penalty. And it's called RMD, which is a required minimum distribution. There is no restrictions on this one. Whereas in retirement accounts, once you hit 72, so there is a IRS worksheet, you have to take out the money as per that. If you don't take out the money, you will be paying 50% excise tax. But here there is no such a restriction. And the money will grow tax deferred. So this is the keyword here, compounding growth, right? So once you get the money, the cash value grows. When the market goes down, you're not losing. And then when the market goes up, you're taking off where you left off, right? We know that, just a simple example, right? If you lose 50% in any asset, you have to make 100% return to even break even, forget about the profit. But so that is the key. So that's what Warren Buffett says, right? Don't lose the principal, rule number one, or the growth. And rule number two is don't forget rule number one. So that is what this one follows. And also it has the living benefits in the time of unhealthiness, like critical chronic illness, we can get the money. Also, this is very, very important, long-term care, right? So back home, most our culture is to take care of the parents or grandparents whenever they're unhealthy. But here we cannot really depending on our kids because the culture is different. So we need to start planning for the long-term care also, because right now it costs about $100,000 to stay in a nursing home, private nursing home. So it will devastate our retirement savings. So it's better to plan for that. So we can, if there is a rider we can add to this policy that will cover for that. So remember I was talking about ADL, activity of daily living. See, for anybody to live independently, these are the things that we need to do independently: bathing, dressing, toileting, eating, transferring, continence, right? So if you cannot perform any two of these, that comes under chronic illness, and we can avail these benefits. So, I mean, everything has a pros and cons, right? So these are the pros that we can think of, and these are the cons that we can think of. So definitely this is not a get-rich scheme. So it takes time. So that's why it's a long-term commitment. And so there are initial policy costs, which you won't have in the 401k and stuff like that. And the rate of return could be less in a given year. Like, for example, there are indexes in the IUL policy that returns as much as 18%. But let's say the stock market goes up 30%, for example, right? So it could yield less in that given year. But beauty is, like, remember I said, when we lose when it loses 40 or 50% or 30, even 30%, we don't lose any money. And then another important thing is understanding the IUL is the key, right? And the purpose is different. So this purpose of this one is basically to give the protection where needed and grow the money tax-free and pass on the legacy tax-free and use the money tax-free whenever you need. So Anil Garu, do you have anything to add?
షూర్ అండి. సో, సురేష్ గారు ఇక్కడ వన్ పాయింట్ అండి. సో యాహ్! ద లాస్ట్ పాయింట్ వాట్ ఎవర్ సురేష్ గారు చెప్పింది చాలా ఇది 100% ట్రూ అండి. మనలో చాలా మందికి ఆ బ్యాక్ ఆఫ్ మైండ్‌లో ఆ టర్మ్ నచ్చదు గానీ, బట్ దట్ సిన్స్ హియర్ ద లాస్ ఆర్ కంప్లీట్‌లీ డిఫరెంట్ యూ హావ్ టు డూ సమ్ అనాలిసిస్ అండి ఇక్కడ. మీరు చూస్తే వెల్తీ క్లయింట్స్ అండి. వెల్తీ క్లయింట్స్ దే must have like 5 to 10 policies and for them, so they are going to keep on the trust on the trust. So what they do is they are going to use this money for the trust and paying the taxes and mutton. They pay multiple taxes and mutton akadade. So that is the key andy. So somebody wanted to have a deep dive, maybe that is a different session andy, but for now that is fine andy.
Yeah. So this is what in a nutshell. It's very hard to run the illustrations in the webinar. So if anybody has questions, so we both are here to help to run the illustrations and stuff like that. Okay. So so many people ask like how safe is the IUL, right? So in the wealth strategy, these are all key factors, right? Risk, guarantees, penalties, liquidity, protection, leverage, tax deferred, tax-free, collateral, tax, like so on and so forth. And some of them we want it, some of them we don't want it. Like for example, what we want, like a risk, we don't want any risk. Guarantees, yes, of course we want to have guarantees. Penalties, we don't like to have penalties. So these are the yes and no's that we want. And these are all the different vehicles for the wealth building strategy, right? So IRA 401k. So does it have risk? Yes. Does it have guarantees? No. Does it have penalties? Yes. I mean, if you take anything above 50,000, you would be paying 10% penalty. So liquidity and use and control, it's possible with a loan or surrender, right? Is it protected? No, there's no downside protection. Does it have a leverage? No. Leverage meaning, let's say if you have a $300,000 in the account, if something happened to that person, that's how much you are going to get, 300,000, not more. Is it tax deferred? Yes, we can defer the taxes up to age 72 currently. So that is when the required minimum distribution kicks in. And is it tax free? No, you have to pay taxes whenever you withdraw the money. So some people think after 59 and a half, they don't need to pay any taxes on the 401k. But whenever you withdraw anything from 401k, everything becomes your annual income for that year. So whatever the tax bracket that you're in at the time, you need to pay taxes. And so you cannot use it as a collateral to take a loan or anything. Is the payments tax deductible? I'm sorry, tax deductible, yes. So whenever you're contributing every year, that money you can take it as a tax deductible for that year. So you don't need to pay taxes temporarily. So does it have a disability benefit? No. So can you transfer the wealth easily? Not that easily. So this is also subject to estate tax, right? So back in India, right, we can pass on 100 crores, 1,000 crores, how much ever you have to the kids. There is no inheritance tax. But there are laws in US, after certain limit, there is a estate tax also. So this one also falls under that. And now talking about the mutual funds, right? When you're investing outside, so does it have a risk? Yes. Guarantees? No. Penalties? Possible. Basically so on and so forth, right? So if you see, yes, that means that has that what we are looking for. No means it doesn't have what we are looking for here. Now let's look at the primary home, right? So does it have a risk? I mean, very minimal risk, but yeah, the home price can go down anytime. But usually in the long run, it appreciates. Does it have any guarantees? No. Penalties? No, of course, no penalties. You can sell it whenever you want to. So you can liquidity. Yeah, you can get the line of credit with the mortgage equity that you have. Is it protected from downfall? No. Leverage? So no purchased with the leverage. So and then is it tax deferred? No. Is it tax free? To the IRS limits, right? So when you sell your primary home, if you stayed for at least 2 years in the house within the last 5 years, you can get up to $500,000 profit tax free. So that's what this IRS limit. So collateral, yes, you can use this equity to get the loan out of it. Is it the tax deductible? So interest portion only tax deductible. But nowadays, the last year, not last year, a couple of years ago, Trump made it $10,000 is the maximum. So we're not, most of us not eligible to get any tax credit on the interest also. So does it have any disability benefit? No. Wealth transfer? Yes, with IRS limits. So a lot of wealthy people, right? They use this step-up technique to pass on the legacy, but the Biden administration is working on to remove that. And now let's look at the CDs, bank and bank savings, right? So does it have any risk? No, because the money won't go down even if the market crashes or anything. But of course, with the inflation, the dollar value that you have in the account is going to go down. Is there a guarantees? Yes, it's like FDIC guarantees up to $250K. So penalties, I mean, if I think this is talking about the CDs, right? In the CDs, if you take out early, there may be some penalties. Liquidity, and so is it protected from downside, like leverage? So basically, this is just comparing what we want here, right? And then annuities is another vehicle where people use for the downside market protection and creating our own pension plan, right? So back in the days in the US, most of the companies used to offer pensions. So this is like kind of similar, creating our own pension plan. And this is the real estate. Real estate means like the investment real estate, not the primary home. So does it have a risk? Yes. Guarantees? No. Penalties? No. You can get the money out if you want to with the equity. Is it downside protected? No. Leverage means, yeah, then, I mean, you can leverage. Basically, real estate is about leverage, right? You can borrow some money and get, put down some money and get more money as a loan, and then the money can grow. Is tax deferred? No. Tax free, it says to IRS limitations, but usually the tax free income is only on the primary home, not on the rental properties. So you can use the money as a collateral. Yes, it is possible. So basically, everyone has a pros and cons, right? So now let's look at the index universal life. So here, does it have a risk when the market goes down? No. Does it have any guarantees? So yeah, the zero is the hero, right? So when the market crashes also, you won't lose money. So penalties, sometimes, like if you close the policy in the very early stage, there may be penalties. So liquidity and control, yes. So is it protected from downside? Yes. And it's a protection means this is also not only downside protection from the creditors or from any bankruptcy, stuff like that. The money from this one is protected. Does it have a leverage? Yes. So what we mean by, let's say if you take $1 million policy, you have only 50,000 cash value. If something happened to that person, you can still get $1 million. That's what the leverage means here. Is it tax deferred? Yes. Is it tax free? Yes. You can take the money tax free. You can use take the loan out of it using the money as a collateral. But the thing is, it's not a tax deductible. So whenever you pay the money into this premium into this policy, you have to pay after tax money. So that is a thing. And then does it have a disability benefit? Yes. Wealth transfer? Yes, you can transfer the wealth tax free. So Anil Gar, would you want to add anything?
Yeah, thanks, Suresh garu. Yeah, that is pretty much a long comparison, and yeah, that is yeah. దీంట్లో మనకి ఏంటంటే మెయిన్ కీ పాయింట్ అండి, వాట్ ఈస్ యువర్ గోల్ అండి. Based on that, you can plan whatever that you wanted to do. That is the main point in here.
Thank you, Anil garu. So next, with the tax-free life savings, right? So like we said, right, anything that you withdraw during the retirement or any time that you need, everything is tax-free. So you can also avoid many people, right? Wealthy people, they use this vehicle to pass on the money to the next generation without any estate taxes. So this is what I was talking about when I said about the critical chronic terminal illness benefits. So we need to start planning for this. So in the future, if something happens like any of these issues, so then we are protected. Our so like I said, right, like these are all today's dollars, by the way. So cost about 100,000 for the private room, 90,000 for the semi-private, assisted living 48,000, so on and so forth. So with this, we're going to walk through the use case scenario. Anil garu, would you please walk through?
Yeah, sure, and thanks, Suresh garu. So this is the simple comparison, and to show you the differences between the term and the IUL, whatever Suresh garu previously చెప్పిందండి. So just to take two simple cases, and for a person of male 45 having a preferred health category, means no body weight, all the health conditions are fine. So for that person, for that health category, so suppose say for a 500k policy coverage for the 35 years term, so the premium is close to $1,240 a day. So the face amount means the policy coverage is close to 500, and he is paying for 35 years. So the policy that is covering 45 plus 35 till 80 years, that he is covered. For this 5,000 coverage, so he is paying around close to 43,400 and for total 30 years. So since previously Suresh garu చెప్పినట్టుగా there is no cash value for the term policies, and so the only thing that he is going to get is the chronicle, whatever the healthcare coverages, and after 80 there is no coverage for him. So if you wanted to have a coverage, then very complex, and they have to pay $1,000 a day. So the only thing that he is going to save is, if anything happens before that time, 35 years, he can use the 500k protection. And then there are two more policies that we wanted to show you the performance IUL, that is for the 500k coverage for a period of 15 years. And suppose say for the same person, so he wanted to take this policy for 500k coverage, the premium is close to $11,272, that is the min, and also the max also that we can pay up to 32,340. So these numbers are coming from the completely legal, and they from the IRS 7702 guidelines, and so for this policy for 500k per 15 years, and he is paying close to 169k, and these are the cash values at the case of 55, 65, 75, and so these numbers are coming from the average rate of return of 6.50 for the next for the lifetime. And so these numbers are going to change as how the indexes are going to perform. So for this policy, at the case of 55, there is a 100k, there is a cash value that he can take it. This is completely tax free, that he can take it for multiple purposes. And then at the case of 65, so that money went to close to 2,063k. At the case of 75, that is close to 461k. See here, the beautiful thing is, where are the term, whatever the 500K that remains same, but here whatever the 500K that is a base, and whatever the cash value that is coming from the policy. So 461K at the age of 75, the total coverage that he has is close to 961K, and that's what previously Suresh garu చెప్పారు కదండి, one of this client took a loan from this policy for some other purposes అని. So that is one thing అండి. దీంట్లో మనకి ఏంటంటే see here అండి, the policy that is still running to the 99 years అనమాట. So if something is happened to the person, the family will be getting the close to 961K as a completely tax free. Then there is a third policy that we wanted to show, that is better than the term, that we call it as a protected policy అండి. దీంట్లో మనము దానికన్నా కొద్దిగా తక్కువ ప్రీమియం పే చేస్తాము. సో సిన్స్ the name that is showing as protected, this is only for the protection that is better than the term. For the same 500K policy, the premium is close to 4,518, that is the min, and the max is 30,000. So he can pay up to 15 years. That is that is a normal thing that we put, but they can pay until they wanted to pay. So this policy that is running till 91. So total contribution that he made is close to 67K, and these are the numbers at the age of 55, 65, and 75, and the total coverage is close to the 645K. The only thing that I wanted to stress out is here, if the person wanted to take a term policy, he is paying around close to 43,000. So there is no cash value for that policy. But here, only thing that he paid maybe close to 20K plus more than the term. There are two different points, and one, the policy that is covering the 91 years, plus he is getting the money back whatever that he put in mutton. So those are the main key 3 points, and then for the same case, and for a female with 36 years of the policy, so these are the numbers on mutton. Generally the premiums for the ladies are close to 1,000 to 2,000 less than the men. There are a couple of factors, and one is the women live longer, and they do not have much stress level than to us. That is there are couple of statistics, and these companies are going to follow. Okay, for the 500K, she is paying close to 432K, and the policy that is covering here till 71, the total funding for the policy is close to 15K. And the second policy is the performance here, you have to see, and the male is paying close to 11K, and she is only paying close to 6,300, and then the policy that is covering to till 102, and these are the numbers, and so 138K at the age of 55, so 65 and 75, and the total coverage at the 75 years is close to the 965K. And the last one is the protected policy, where people do not want to pay more. So you still they can take policy with the 2,436 per year, and they can plan up to 15 years, and that the total funding per the policy is close to the 36,500, and these are the numbers, and so finally, there are multiple ways, and how whatever that you wanted to do, so we can do that, deep dive and provide a better solution, and yeah, this is the second sample that we wanted to show. Is how the life insurance can be used for the wealth and retirement. So these plans are called the LARP plans. So for the same, suppose say if a person is at 40 years age with the 50 plus health category, so maybe he can't contributing close to 15,000 per year, and maybe he contributed like 20 years anukundamanడి. So the policy that is covering him to 131 years, and the total contribution for this policy is close to 300K, and see the values and at the age of 55, 65, 75, close to 75K, manake close to there is a 1.3 million dollars and so those are the numbers. So now he properly funded the policy, so 300K. So previously మనకి సురేష్ గారు ఇందాక మనకి చెప్పారు కదండి మనకి కాంపౌండింగ్ అని చెప్పి. సో హియర్ by taking that compounding, so the money went to close to 1.39, and we get the age of 65, the total funding, the total value, the total cash value is close to 700K, that is completely tax free. From this amount starting from 65, he can take up to 70K, close to 70K every year for the retirement purpose, that is completely tax free. So he almost took for 20 years, so he got the funding up to 85 years. The total funding is that the total money that he took from the policies close to 1.38 million and then still at the age of 85, if something is happens, still the family still get close to 292K as a completely the tax free and suppose that the person live maybe up to 102, yeah, maybe that is more, but say for at the case of the 130, that is the last the policy that is going to run, the total cash value or the death benefit is close to 18 millions and
Yeah. So just to add a little bit on that, right? So basically, the client paid, the insured paid about $300,000 over the 20-year time frame, and then he could potentially take $69,000 per year, which is about $1.384 million. This is everything is tax free. And more importantly, see, if you see it here, the growth rate we're projecting here is only with the 6.59. I mean, we all know that even S&P 500 in the long run performs about 8 to 9%, right? But here it is shown very conservatively. So you could potentially get more money than this one. I mean, I have seen in my own policy getting more returns. So the next one is, we'll go to FAQ. So Anil Garu, would you want to start?
yeah, sure, Andy. The first one, Andy, is term insurance is useful. So డెఫినెట్లీ అండి. సో మనకి ఏంటంటే మనకి ఎట్లాగో ప్రొటెక్షన్ కావాలి. సో మేబీ యూ కెన్ బేస్డ్ అపాన్ ద యూజ్ కేస్ ఆర్ బేస్డ్ అపాన్ ద రిక్వైర్మెంట్ దట్ యూ హ్యావ్. సో యూ కెన్ టేక్ a simple term policy that can give you the protection for the specified and number of pairs అండి.
Yeah, so it's basically to have a family protection, and you'll be paying much less, but that gives a good family protection financially without going any GoFundMe pages and stuff like that. And so can the term policy only for green card holders or US citizens? No, even if you're an H-1B, you can get this policy. If I take the term policy while in the US, can it cover person beneficiary if living in any country? So we can give a use case scenario. And 2 years ago, somebody that took the policy in the US, that person died while he was in India with the COVID. So he got paid $1 million death benefit. So in other words, once you start the policy here, it is covered at anywhere.
one
Yeah, please.
one point అండి ఇక్కడ సురేష్ గారు సారీ అండి యా ఫర్ ది సేమ్ కేస్ అండి మనకి ఈ కంట్రీలోనే ఉంటే సో దే ఆర్ గోయింగ్ టు కవర్ ద క్రానికల్ ఆర్ వాట్ ఎవర్ దట్ ఈస్ అండి బట్ వేరే కంట్రీలో ఉంటే ఓన్లీ దట్ ద బెనిఫిట్ దే ఆర్ గోయింగ్ టు ప్రొవైడ్ అండి.
So are the IUL contributions tax deductible, Anil garu?
No అండి, since whatever the cash value coming from the policies are completely tax free. So that is the reason you cannot claim the whatever the premiums that you paid and
Yeah. So what is the average return of an IUL policy?
అది మీరు ఇందాక
Yeah. So I
చెప్పారు
can
కదండి అది.
I can
Yes,
answer this question, Andy. So I mean, we can get anywhere from 8 to 10%. But in my own policy, I got about 8.99 even in the downturn this year. Um, but the beautiful thing is the money won't go down when the market goes down. So how safe are the IUL investments, Andy, Anil garu?
yeah, previously మనము we went to the complete with కదండి. Yeah, so they are safe అండి, but the main point is what is the goal అన్నమాట for you, what you are looking like, what you are planning to get out of this policies and those are going to give you the summary and
So can you lose money from the IUL policy?
no and so that is very rare because of these companies. They work on the floor and cap strategies and also Suresh garu ఇందాక మనకి చెప్పారు కదండి the market downfall protection అని, the money never goes to that too Sunday.
And can you take the money from IUL?
Yeah, sure and definitely. So when there is a cash value from the policy, so you can take the money in multiple ways, maybe the loans or maybe withdrawals and
Yeah. So I can take this question. Is IUL better than 401k? Ante? So these are two different vehicles, Ante. So 401k is a tax deferred, right? And also in 401k, right? It is always better to contribute and at least the company match. So because most of the companies give dollar to dollar match, right? So like most of the companies match up to 6%. So up to the 6% of the salary, it is better to contribute it to 401k because you're getting 100% ROI right off the bat. And rest of the money, it is better to put it into the tax advantaged, such as IUL, Roth IRA, and stuff like that. Would you want to add anything, Andy?
yeah, no, that is fine and
So I think we explained this.
yeah.
What is a max funded policy, Andy?
Yeah, so బేసికల్గా అండి మనం ఈ పాలసీస్ దే వర్క్ ఇన్ మల్టిపుల్ వేస్ అండి. మనము తక్కువ ప్రీమియం కడితే ద పాలసీస్ విల్ గో ఇన్ ద సేమ్ వే. సో ఇందాక 2 ఎగ్జాంపుల్స్ మీకు మేము చూపించాం కదండి, 1 పాలసీ విత్ 11K అండ్ 1 పాలసీ విత్ 3K 4K. So those are the main అండి. So
Yeah.
the same thing with 4,518 is growing very less, and so with the 11,000, that is see the cash value at 75 and 461 versus close to 140K. So close to there is a 3 close to 280K or yeah close to that is the differences and plus that too you can start early. So maybe starting 15 years, once you fund the policy, then the policy has the more value to get the rate of return and they can work better and
Yeah. So just to add to that, Andy, every policy has the suggested minimum annual premium and also suggested maximum, not suggested, but IRS limit on this, the maximum value, right? So the reason they do the maximum restriction on the any policy is not to abuse the tax savings, Andy. So let us say if you take a half, these numbers minimum and maximum are defined by the policy face amount and age and the gender. So let's say, for example, somebody take a $500,000 policy, and then because there are so many tax savings, if you fund 100,000 to avoid that kind of a problems, IRS put the limits on how much maximum that you can pay. And coming back to the minimum, what is the advantage of minimum and versus paying maximum? So the more you fund, obviously the more growth that you see, the money that you can tax deferred and you take the money out tax free. And then is the IUL distribution tax free or tax deferred?
We covered and that one.
Oh, it's what, right? Okay.
Yeah.
So I think that's all we have nowadays. So we can open up for the questions. We'll be happy to answer any questions in the chat or the phone. Ramagaru?
Yeah, great, Andy. Thank you very much. I think we have a few questions on the chat. Like I'll just read out.
Yeah.
Are IULs similar to UL IPs in India?
Yeah, those are similar, Andy, but in India, ULIPs are, there is no market downside protection. They go up as the market goes up, and then they go down as the market go down. So that is here the comparable product in the US is VUL. It's called variable in universal life. So IUL, the floor is 0, so we don't lose money when it goes down. But whereas the ULIPs, you could lose the money when the market goes down.
Okay, great, sure. And Kondala Saladigaru is asking, like, these are individual plans. Do we also have family plans, which will cover everyone in the family, including kids?
No,
Right.
these are individual plans. You have to take it on the different individual.
Okay. And Ramagaru, yes, sorry, Ramagaru, one more question and then we can take it. Last question. This is from Ramagaru. How much is 200K worth after 40 years?
It all depends on how the inflation is, right? If the inflation, the way it is continuing right now, we don't know. But at the same time, if you keep the same money in the even 401k or even in the bank, it would be the same, right? So usually, typically, the inflation doubles every 20 years, and in the US. I mean, last 1 year is different. The reason being the government printed about $8 trillion in the last 2 years COVID time.
Got it. Sure. Ramagaru, please go ahead. I'm not sure. Or if anyone else has any questions.
I think somebody was asking the question, right?
Yeah.
Please feel free to ask any questions, and no question is a simple question. So we'll be happy to answer any questions that you may have.
Yeah. Kishore Garu is asking, is IUL advisable for a person earning 100K or only for the ultra rich?
No, anyone. So what we do is look at their financial situation and start the policy appropriately. Like let's say, first what we do is we do the dime method, Andy. So to figure out what is their actual coverage that is needed. Let us say they need a coverage of 1 million, for example. So then we look at see what their funding that they want to pay. Let's say they want to pay only about $6,000 per year, for example. So we will cover as much as possible with the term life insurance, because that is very important family protection, right? The rest of the money we can cover in the IUL. So to answer your question, no, it's not for ultra rich, and for anybody and everybody, because see, two things that you need to plan in this country, apart from the regular day-to-day expenses, is college kids education, and then other one is the retirement. So unless you start in as early as possible in the life, it is hard to get to those goals. Yeah,
great. Yeah. So Harigaru asking, is IUL preferred over term policy?
It all depends on the family situation and the budget and so like I said that in the example before, so let us say if they have money to pay only for the term insurance, it's better to go with the term insurance only. But if you're able to save money, if you need to save money for retirement and college education, it is preferable to go with the IUL. So like in my case, right, I can give my own example. I did the DIME analysis and then so I came up with about $1.5 million. But so I took a $1 million term policy and then $500,000 IUL policy, but that's a max funded. So right now I'm paying, I can pay around $12,000, but I'm allowed to pay by the IRS rules up to 24,000. So I'm paying the 24,000 to secure my retirement.
Okay, great. I think Satvik Garu has the same question. I think that is already covered. Term or IUL better if you need only for life insurance?
Based upon the goal and Suresh garu mandaga prepare kadandi. So if you have only the so limited funds for the term, maybe you can go with this one. So later, maybe you can convert the term to perm also.
Yeah.
Okay. And Nagagaru is asking, can we do a mix of term plus IUL initially and gradually increase the IUL face amount and reduce term face amount each year?
Yes, sir. That's yeah, that is the, yeah, it's a beautiful question, Andy. Thank you for asking me that question. Yeah, so depending on the budget, we can design the policies in a mixed, some term, some per. And then as the age pass by, if you want to convert the term into the per or the IUL, we can do so without any underwriting. Even the health goes bad. As I can give you a classic example, Andy. So now the client came to me 2 years ago. She really liked the IUL and she wanted to save the money for the retirement. And then during the question and answer session, she said she has a diabetes. And so diabetes means the rating won't be preferred plus, it would be standard or table rating. Then I was telling her, yeah, it may be tough to get a good rating for you. Then she immediately realized she did the term policy 5 years ago when she was healthy. So I was simply able to convert the policy from term to perm without any additional underwriting. And then she got the preferred plus rating, even though she has diabetes. So that is the beauty. It's better to lock in the health rating as early as possible when we are healthy and young.
Great. Yeah, thank you, Sushil. And next question from Jay Prakash Garu. What is the minimum contribution for this plan? Also, what's the different charges that we may have to pay for the first 5 to 10 years, 5 or 10 years?
Yeah, sure, Andy. There is no minimum contribution, Andy. It all depends. The minimum contribution depends on the face amount, gender, and the age. And also other beautiful thing about IUL is it's a flexible plan, right? So in other words, you can start with only $5,000. You can move up to the maximum as your budget permits. And then you can also scale down. In other words, let's say in the example that we've shown, the minimum was 11,000 and maximum was 30,000, right? For example, you can start off with 11,000. And then maybe next year when you have a bonus or anything, you can pay 15,000 up to 30,000. And let us say 1 year, after 3-4 years down the road, you don't have money at all to pay for the policy. Then you can pay zero. So like many of my clients this year, they called me and said they don't want to, or they cannot pay the premium because they lost a lot of money in stock market. So we pass their payments, but the policies still continue. So that is the another flexibility. And then regarding the policy charges, so there is the initial policy charges for the life insurance, because they're providing the life insurance, right? So from day one, let's say if you take a $500,000 policy, from day one, the death benefit is covered up to $500,000, including the critical chronic terminal illness benefits. So there is a charges for that. And that are also depending on your health condition. So the less health you are, so the better health you are, the less charges there are.
Okay, great. Thank you.
Yeah.
And Hari Samudra garu asking, are there suggested companies to take IUL?
Yes, Sandy. So we deal with many companies. AIG is one, Transamerica is one. Then the FNG is another company. North American. There are multiple companies. Depending on the client's profile, we suggest a different company. But yeah, there are many companies that are.
Okay, great. Okay. Satish Garu's question is, only US citizens and GC holders can take IUL or any visa holders? I think this you answered in the session.
Yeah, any visa holders.
Yeah, one point and ikkada. So yeah, so if suppose and if maybe they wanted to wait for a couple of years on Konde, what they can do? They can take a term now and lock in the health category. So later they can change the term to the permanent.
Yeah.
Okay. Sure. And what are all the diseases or conditions come under critical illnesses?
Critical illnesses are typically the heart issues like a heart stroke, invasive cancer, and like any stroke, like that. And I can give you the comprehensive list.
Okay.
You don't have it handy,
Also,
but yeah.
Venkat Garu has also a second question. In case the policyholder expires 60 years, do the dependents still get the benefit after the initial matured amount, and how long will they get benefit?
Yes, and so if it is a IUL policy, that is the beauty, right? So whenever the proposed insured dies, whatever the death benefit is available at that time, so they can get all that. Like for example, so in this case, right? So in the example that we were showing, so here the client paid total $300,000. So the client here paid total $300,000, right? And then they started withdrawing the money for the retirement, about $69,000 from age 66. And then they withdrew up to, let us say they withdrew 10 years, which means they withdrew about $700,000, right? And then that time the proposed insured dies, they'll get about $540. Or let's say the proposed insured, they took all the money for 20 years. So which means they withdrew about $1.38 million. And if that time the proposed insured dies, they will get about $251. So whatever the money shows in this death benefit column, that's what they get. So let us say they took for 20 years and then they're not taking anything after that. The remaining money is still growing. If you look at here, right? Due to the space, we did not show the entire illustration. But if you see here, at the age of 90, their death benefit is $481 after taking about 1.4 million distribution. And then at the age of 130, it's about $18 million. Basically, the rest of the money compounds.
Suresh Garu, this is Venkat. Can I ask a question live?
Yes, please. Yes, please. Yeah.
Can you please go back to previous slide? Slide la meeru 55 years ko amount, 65 ko amount, 75 ko amount cheppara ee amount. So my question is more about this one actually.
Sure.
So for example, if someone took a policy and the IEL policy,
okay,
so they died at around 60 years. So
okay.
55 years they might have got around 100K. That's what they're supposed to get. The second one.
No. Sorry, Andy, the 100,000 is the cash value that you can take out for any purpose, not the death benefit. So death benefit would be much more.
So 100K plus 500 and yeah.
Okay, 500 plus 100K,
Yes,
so around 600.
Yeah.
So if they, for example, if they are no more after 60 years or around 60 years, so the beneficiary will be getting that some value, whatever the sum is, whatever that, like by the time it may be 200K or whatever it is, plus 500K.
right.
So after that, do they still get this the benefit, the monthly or annual benefit?
No,
Yes,
no. Once the proposed insured dies, they'll pay out whatever the benefit amount there is of death benefit available, and they close the policy.
Okay, that's my question. Thank you.
So,
Okay, one more question
Hello,
from
Suresh garu, Anil garu. Yeah, thank you, Andy. Just I would like to add something, Andy. I am Rao Kotte. I am also a financial professional. Regarding the question from Kondala Saladi garu, can we including the kids? One flavor is there, Andy. For that, you can add the kids, but for the less amount. I just wanted to add that comment. Thank you.
Yeah, that's only about $10,000. Yeah, you can add.
and Kondala garu was asking, does IUL covers all the benefits covered in term insurance?
Yes, it covers all of them that are covered in the term plus more, Andy. So the one of the benefit is you can add the long-term care rider in the IUL, but not in the term policy. So which is very, very beneficial in the long run. So you can get 2% of the death benefit every month, and if something happens with the chronic illness, like for example here, right? So here, let's say at the age of 66, something happens to that person, so they can get 2% of the 829K per month. So which is about $16,000 per month they can get in IUL.
Okay, sure. And Punesh garu is asking, is whole life insurance different from IUL and term insurance? If so, how are they different?
Yes, Andy. So the whole life policy is basically like a New York life policy, stuff like that. So their growth pattern is different, Andy. The way they the cash value grows. So the average it's about 3 to 4%, Andy. So they don't depend on the stock market performance, but it's about 3 to 4%. So in the long run, even if you get a 1% extra, with the compounding effect, right? The IUL is much better. So this is
Yeah.
like old type scenario, Andy. So if you compare with the flip phone versus smartphone, flip phone is the whole life, and then smartphone is the IUL.
ప్లస్ అండి వన్ పాయింట్ అండి సురేష్ గారు, అక్కడ ఇది మనం ఈ హోల్ లైఫ్ కి వెళ్ళినప్పుడు మనం ప్రీమియమ్స్ అది మనకి అది మనం ఫ్లెక్సిబిలిటీ లేదు, దట్ యూ హ్యావ్ టు పే అంటిల్ 60 or 65.
You're correct. Yeah, thank you. Yeah, that's a good point. So let's say if 1 year you don't have any premium money to pay, so they will take out the entire money from the cash value that you have, and you're obligated to pay every year.
Okay, great. So that's all from the chat, Andy, unless if anyone has any other questions, like you can just. Okay.
Yeah, I think we have almost
Great.
done.
I think, yeah, covered. Yeah, it's just over an hour as well. But thank you very much, Suresh garu and Anil garu. That's a great session.
Okay.
Hope,
Thank you. Yeah, I think there is one question.
One
Yeah.
question, Andy, from Venkat P. Garu. The question is, one second, Andy. Let me go to that.
Oh, did I miss one?
I think the
Yeah,
question
it looks like,
how do you-
yeah, how do you compare various IUL policies from, okay, IUL policies from different companies like AIG versus any other company?
Yeah. So I mean, you can contact either Anil garu and myself one day. So we'll be happy to show you the differences, and then show you run different illustrations, because it's tailored to different individual.
All right. That's it. Thank you very much, everyone. Thanks for joining.
Yeah.
Hope
Thank
you
you.
have a great
Yeah.
Sunday. Yeah, take care. Thanks. Bye.
Thank you.
Bye.
స్టాప్ చేశారండి రికార్డింగ్ అండి సురేష్ గారు? I think he already left. Okay.